Every week, someone sits down across from me and says the same thing. My advisor told me I need to do Roth conversions. The tax rates are going up. I need to act now or I'm going to regret it forever. And every week, I have to tell them the same thing back. That advice, the advice your advisor gave you, the advice the financial headlines keep screaming at you, is costing people with $500,000 or more in their 401k tens of thousands of dollars they didn't have to spend. Here's what nobody is telling you. Roth conversions don't solve a tax problem. They create one. They take money you haven't paid taxes on yet, force you to pay those taxes right now, at today's rates, in today's bracket. And they trigger two hidden tax bombs most advisors never mention. IRMAA surcharges on your Medicare premiums and the taxation of your Social Security income. And the worst part? For most people with $500,000 or more sitting in a 401k or IRA, the problem Roth conversions are supposed to solve can be solved another way, a better way, a way that costs you nothing in upfront taxes, grows your money with a zero-loss floor, and creates tax-free income for the rest of your life. I'm James Caldwell, and today I'm going to show you exactly why smart retirees are ditching Roth conversions and what they're doing instead. Let me start with the problem. You have $500,000 or more sitting in a traditional 401k or IRA. Every dollar of it is pre-tax money. And someday, either when you start withdrawing it or when the government forces you to at age 73 through required minimum distributions, every single dollar will be taxed as ordinary income. That is the freight tax train, and it is coming whether you plan for it or not. So your advisor says, convert it to a Roth now. Pay the taxes today. Never pay them again. Here is why that logic breaks down for people in your situation. When you convert $1 million, or even a significant portion of it, you do not just pay taxes on what you convert. You stack that converted income on top of everything else you are already earning. Social Security, pension income, investment income, IRA distributions you were taking anyway, and the moment you cross into a higher bracket, you are paying 22%, 24%, even 32% on those converted dollars. You are paying premium tax rates today to protect yourself from what exactly? The same rates? Higher rates that may never materialize? The math does not work the way the headlines say it does. Here is the actual calculation for a couple converting $100,000 in a year when they already have $60,000 of other income. $60,000 base income plus $100,000 converted equals $160,000 total ordinary income. After the standard deduction, roughly $120,000 is taxable. That pushes them squarely into the 22% bracket, paying $22,000 in conversion taxes on the converted portion alone, plus taxes on the base income. Over a 10-year conversion plan at $100,000 per year, $220,000 in upfront taxes paid out of pocket, gone forever, never compounding. Here is the one your advisor almost certainly did not mention. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a Medicare surcharge that activates the moment your income crosses certain thresholds. It is calculated using your income from 2 years prior, so what you earn today affects your Medicare premiums in 2 years. In 2026, a large Roth conversion can add anywhere from $70 to over $400 per month, per person, to your Medicare Part B and Part D premiums. For a married couple doing a significant Roth conversion, that is a hidden additional cost of $840 to $9,600 per year. Every year, the elevated income pushes you above the threshold. Nobody puts that number on the Roth conversion spreadsheet. The spreadsheet shows you the tax on the conversion. It does not show you the IRMAA cascade. It does not show you the additional Medicare premiums stacking up for the next 2 years. The total cost of a Roth conversion is meaningfully larger than the tax bill alone. Your Social Security income is not automatically taxable. Whether it gets taxed, and how much, depends entirely on your combined provisional income for the year. For a married couple, below $32,000 combined income, none of Social Security is taxable. Between $32,000 and $44,000, up to 50% may be taxable. Above $44,000, up to 85% is taxable. When you do a large Roth conversion, you spike your income for that year. The conversion income stacks on top of your existing income, Social Security, pension, investment income. You push yourself from the 50% taxable zone to the 85% taxable zone on your Social Security in a single move. You just created a second tax bill inside the same tax return, the conversion tax on the converted dollars, and more tax on Social Security income that was previously sheltered. 3 tax consequences. 1 Roth conversion. The spreadsheet typically only shows the first. So if Roth conversions are the wrong answer for most people with $500,000 or more, what is the right one? This is where the protected tax-free container changes everything. Instead of paying taxes now to move money into a Roth, where it sits, grows, and eventually distributes, you reposition that same capital into a properly structured indexed universal life policy under IRC Section 7702. Here is what that means in plain language. The cash value inside this policy grows linked to a market index. If the market goes up, you earn more. If the market goes down, you do not lose any money from that index performance. Zero floor, no negative years, no watching your retirement savings evaporate in a down market. The growth is tax deferred. The distributions come out as policy loans, not taxable income. The IRS does not count policy loan distributions as income. They do not trigger IRMAA. They do not push your Social Security into the 85% taxable zone. They do not show up on your tax return. And when you pass away, the remaining death benefit transfers to your heirs income tax-free. No probate, no courts, in days, not years. The cash value inside a properly structured policy is classified as a Tier 1 asset, the same category banks use for cash and U.S. Treasury bonds. JP Chase, Bank of America, and virtually every major bank in the country hold billions in this structure on their own balance sheets. They call it BOLI, Bank-Owned Life Insurance. If it is good enough for JP Chase, it is worth understanding why. Now let me show you what this looks like in real numbers. Meet Robert. He is 64 years old, retired 2 years ago from a career in manufacturing management in Texas. $1 million in his 401k. His financial advisor, a good advisor, a well-meaning advisor, told him to start Roth conversions immediately. Convert $100,000 per year for 10 years. Pay the taxes now, sleep better later. Here is what that plan actually costs Robert. $100,000 converted per year at a 22% effective rate. $22,000 in taxes per year. Over 10 years. $220,000 in upfront taxes, out of pocket, never compounding, gone. Plus, IRMAA surcharges triggered every year of the conversion, an additional $3,600 to $9,600 per year per couple, depending on how far income crosses the thresholds. Plus, the Social Security taxation spike every year he converts, pushing more of his Social Security into the 85% taxable zone. Robert's Roth conversion plan, the plan designed to protect him, costs him somewhere between $250,000 and $320,000 in total taxes and surcharges over the conversion decade. Now here is what Robert does instead. He repositions that same $1 million, not all at once, but systematically through a properly structured premium funding strategy, into a protected tax-free container. The cash value grows at market-linked rates with a zero-loss floor. He accesses it through policy loans, zero income tax, zero IRMAA trigger, zero Social Security impact, and the death benefit protects his wife Patricia if he goes first. The freight tax train is still coming. Robert just stepped off the tracks. One more thing before we close. Some of you are thinking, what about the pre-tax deduction I got when I put money into the 401k? Doesn't that mean I have to pay taxes on it eventually? Yes, you do. But there is a meaningful difference between paying taxes on money as it comes out in small, controlled, managed amounts versus paying taxes on a massive lump sum conversion at peak rates, with IRMAA surcharges, with Social Security spikes all in the same tax year. The protected tax-free container lets you control the pace. It lets you sequence. It lets you decide when, how much, and in what order. Not the IRS. Not your RMD schedule, not a conversion deadline your advisor invented. That is what smart retirees are doing instead. Here is your mirror moment. If you have $500,000 or more in a traditional 401k or IRA, and someone has told you that Roth conversions are the answer, I want you to ask one question before you write that tax check. What is this conversion actually costing me? Not in theory, in real dollars, including IRMAA, including Social Security taxation, including what that money would have compounded to if it had never left my account. If your advisor cannot answer that question with a specific number, you don't have a plan. You have a sales pitch. Below this video is a link. Book a private, one-on-one 401k rescue strategy session with my team. We will run your specific numbers, your IRA balance, your income picture, your Medicare situation, and show you exactly what the Roth conversion is actually costing you and what the protected tax-free container alternative looks like for your situation. You have spent 30 years building this. Spend 30 minutes protecting it. Rescue, reclaim, retire richer.